Hello and welcome to yet another episode of Legal Wrangle on International Taxation and Domestic Taxation. In this episode, we will present before you cases relating to allowability of swapping cost incurred under forward contracts, TP adjustment on account of notional benefit to AE and applicability of benefits of Article 8 in case of slot hire. We will also discuss a case that focuses on the amended provisions of Section 2, subsection 15 and a case relating to the applicability of TDS provisions on salary payable to priests and nuns when they do not receive salaries in their personal capacities but pass the same on to the diocese. In first case of today's episode, the key issue was whether the swapping cost incurred by an entity for entering into forward contract with the banks for repayment of foreign currency borrowings on a due date can be treated as deferred expenditure or not. The assessee, GE Capital Services India, was engaged in rendering financial services for healthcare, media, consumers, real estate and aviation.
During the relevant year, the assessee had borrowed in foreign currency and swapped it into Indian rupees in order to augment its rupee resources for meeting its lending requirements. For repurchasing these currencies on the respective due date of repayments, the assessee entered into forward contracts with banks as a safeguard against forex fluctuations. The assessee treated the difference between forward contract rate and exchange rate on the date of transaction as cost of borrowing and claimed the same as revenue expenditure. The said claim was, however, rejected by the ITO, who held that such loss was contingent or notional.
The tribunal observed that the swapping cost incurred by assessee by entering into forward contract was capable of determination at the time of execution of forward contract. Once it is crystallized and formalized on the date of entering into the contract, the liability arising on account of such contractual obligation is to be allowed in entirety in the year in which the same has occurred, and it cannot be treated as deferred expenditure. In our second case, the key issue is whether a TP adjustment can be proposed on account of AMP expenditure in absence of contractual obligation as to sharing of expenses merely because the expenditure incurred by an entity had indirectly helped in augmenting the brand value owned by its overseas AE. The assessee, that is Mondelez India Foods Private Limited and previously known as Cadbury India Limited, is engaged in the business of manufacturing and marketing of malted food, drinks and chocolates.
The assessee during subject year entered into technical assistance and royalty agreement with its AE for availing benefits of technical know-how developed by the AE relating to the manufacturing, processing, distributing and marketing of its products, and accordingly claimed AMP expenditure incurred on account of the same. The ITO, however, disallowed the same on the ground that the expenditure incurred by assessee had indirectly helped in augmenting the brand value owned by its overseas AE.
The ITAT observed that there exists a fine distinction between products promoted and nurtured by an assessee and the brand owned and supported by its AE. Therefore, until and unless there is sharing or incurring of AMP expenditure by an assessee on behalf of its AE, it cannot be held that it should have recovered some amount from the AE on the ground that the expenditure incurred by it indirectly helped in augmenting the brand value owned by its overseas AE. The tribunal clarified that the Indian TP provisions do not cover a perceived or notional indirect benefit to the AE due to incurring of certain expenditure by an assessee in India. In our third case, the key issue is whether a non-resident assessee is entitled to treaty protection from source taxation in respect of income arising from transportation of goods by operation of ships in international traffic, irrespective of whether or not such ships were owned or chartered by the assessee. The assessee, that is Kcargo Global Agencies, is a tax resident of Indonesia.
The assessee during the subject year had derived income from slot chartering in certain vessels sailing from the port of Mundira and claimed benefit of India-Indonesia DTAA by filing its return under Section 172. The ITO, however, denied the same, observing that vessels in which the containers were transported were not owned or chartered by the assessee. The ITO held that the benefit of DTAA would in any case not be available to the slot charter who has just loaded a few containers on board.
The tribunal observed that Bombay High Court in this case of CIT versus Balaji Shipping UK Limited had categorically held that slot hire facility is an integral part of the contract of carriage of goods by sea and therefore eligible for treaty protection against source taxation of such income. Therefore, the tribunal held that since the slot hire facility is directly linked to the business of operation of ships in international traffic, the profits from slot hire activity are also entitled to treaty protection under Article 9 of India-Indonesia DTAA. The tribunal further held that profits earned by assessee in respect of operation of ships or aircraft in international traffic are taxable only in the country of its fiscal domicile, that is Indonesia. In our fourth case, the issue was whether, in view of the amended Section 2 of Income Tax Act, restricting the definition charitable purpose by excluding carrying on any trade, commerce and business in receipt of an amount in excess of Rs 25 lakh would by itself entitle the Director of Income Tax to cancel the registration under Section 12AA. The assessee involved here is Khar Gymkhana.
The assessee is a registered trust. The Director of Income Tax cancelled the registration granted under Section 12AA on the ground that the activities of the trust were not genuine or were not being carried out in accordance with its objects. The appellate tribunal had allowed the appeal of the assessee by setting aside the cancellation of registration, considering the same as unjustified.
The High Court favoured the assessee and held that registration granted to a trust under Section 12AA cannot be cancelled merely because the receipts on account of business of the said trust exceeded the cutoff specified in the proviso to Section 2. The court further held that the Circular number 21 of 2016 makes it clear that the amendment to the definition of charitable purpose by adding of the proviso would not ipso facto give jurisdiction to the CIT to cancel the registration under Section 12AA. In our last case of today's episode, the issue is whether in a case where salary received by a priest or nun goes directly to the congregation or diocese that is exempt from tax, is there any need for deduction of tax at source? The assessee here is Holy Cross Primary School. Let's have some details of the case.
The assessees are in Catholic institutions, religious priests and nuns who were employed in the respective schools owned and administered by diocese, congregation or institutions. Whenever salaries were directly paid by the government to the concerned religious priests or nuns who were working in the schools owned by Catholic diocese and congregation, TDS was sought to be deducted, whereas the concerned religious priests and nuns did not take the salary as their individual salaries. Instead, they were depositing the same to the diocese or congregation or institution only. Therefore, they had no personal link in so far as the salary received from the government.
On a writ petition against deduction of tax in such cases, the tax department stated that when the ultimate beneficiary is the congregation that has been exempted from tax, there is no need to deduct tax at source. However, the money should be given directly to the institutions and not to the individuals. Accordingly, High Court ordered that in order to get exemption from TDS, every priest or nun has to specifically give an undertaking affidavit to the department that his or her entire salary as a teacher or non-teaching staff or in any other capacity has to be paid by the government directly to the congregation or diocese to which he belongs, which has already been exempted from payment of income tax. The High Court ordered that on receipt of the affidavit, the Income Tax Department would give a certificate or a letter to the state government that there was no need to deduct tax at source insofar as the priests and nun are concerned. Well, this brings us to the end of this episode of Legal Wrangle on direct and international tax. You may write to us your comments, criticism and counsel at editor@tioltube.com. Please do subscribe to the TIOL Tube channel on YouTube. It's free and will keep you updated on our new posts. Have a good day.